right, very good afternoon and Happy New Year to valued clients and business partners. Happy New Year 2026 to all of you. May your portfolio grow faster than Malaysia's cost of living. So just a quick mention. Did you know last year our Department of Statistics Malaysia, in short we call DOSM, so they released this our very own nasi lemak inflation. You know, whereby they actually track McDonald's price, the Big Mac in KL, Singapore and London. And then from there, they compare the cost of living in each of these countries. So back to our own nasi lemak inflation. Did you know this nasi lemak in 2011 cost you 2 ringgit and 3 cents? In 2024, the very same nasi lemak inflated to 3 ringgit and 68 cents. That's about 81% inflation rate over the last 13 years. So if you were to analyze it, that works out to almost 6% inflation. So the question for FSM Expo in 2026 is, in addition to how do we invest in 2026, I feel that the real question is that how do you grow your money faster than inflation without taking too much risk, of course? So that's the topic of my session today. It's all about how can we leverage on market environment in 2026, building the income that can last, a very good level of a meaningful income that can really last, beating our cost of living in Malaysia. So first of all, I want to thank my business partners, AHAM Asset Management, and also FSM for having me here today to share with you our outlook and strategy for 2026. So, from Franklin Templeton, how do we see the market and why income investors should care? Think of the economy is like the car that you are driving today. Federal Reserve, the US Federal Reserve, want the car to be traveling at the optimum speed. Not too fast, not too slow. So if you look at in 2022, when the car moving too fast, overheat already, so they need to slam on the brake to stop the car. So that's raising interest rate. When inflation too high, the car traveling too fast, the Federal Reserve step on the brake. That is why market actually suffer a drawdown, a heavy drawdown in 2022. And then if you look at the others environment, excuse me, this one, when the car is moving too slow, what do you do as a driver? You slam on the gas, accelerator, right? To make the car travel again. So what happened was, in the last 2 years, the US economy, which is the car, started to slow down already. That's why the Federal Reserve has been cutting interest rate in 2024, last year 2025, and more to come for 2026. Maybe about 1 or 2 cuts. But essentially speaking, ladies and gentlemen, we think the US economy is still in a healthy shape. Economy is still resilient. Last year, before all of us went to New Year holiday, the Q3 GDP was better than expected. Because of the, why? Because the resilience of the consumer in the US. But on the other hand, the job market in US is slowing down, which is the car. So the Federal Reserve, which is the driver of the car, they have to cut the interest rate to make sure the car move again. So far, the way we see market, the key takeaway is that rate cuts are good for markets because it support growth. In addition to that, rate cuts, sometimes investors ask, if I'm income investor, would that mean I earn lesser income? Because interest rate has been cut, right? All of you would have realized our fixed deposit rate, not only in Malaysia, from US to Singapore and Australia down under, are trending down. So, but when it comes to market, there's a way to walk about it to make sure that your income stay resilient, although interest rates are cut, but you can still benefit from market simply because rate cuts are coming. So in our view, rate cuts support growth. Not all rate cuts are bad news for investors. That brings to my next point in terms of many investors ask me, right, David, is rate cut always good for markets? Dependent, actually. Generally speaking, rate cuts are good for markets, but not all rate cuts are definitely good for markets. Let me tell you why. If you look at on the right-hand side here, if the interest rate cut by any economy, US, Malaysia, when they do it, but the economy already in recession or near to recession, or even still, the car that you are traveling completely stopped. It's too late already. We call it recessionary cut. Typically speaking, market will be in bear market, typically about 3 to 6 months. About bear market, before the rate cut will start to show effect, positive effect. But this time around, we are more on the left-hand side here, ladies and gentlemen. This is more a maintenance cut. Back to the car example, when your car started to slow down a little bit, if you are the type that typically don't sleep when you're driving, which is quite dangerous, so you try not to sleep when you're driving. When you realize the car starts to slow down, you press on the gas. That's where we are today. So we feel Federal Reserve of United States is more on the maintenance cut to support the market. So that means today's environment looks closer like maintenance cut. And generally, this is good news for income investor. With that, if I may move to the next slide, to conclude on question 1, ladies and gentlemen, rate cuts can create a very good income today. Despite rate cuts has been implemented by the US in the last 2 years, we still see compelling yields from bonds, equities, and hybrid securities. Not to mention, today at the current income level, you are compensated to wait for your capital growth in the future. So essentially, throughout my session today, you will find out more about how we can build a passive income that fund your lifestyle today while building your retirement portfolio in the future. So that's my intention to share with all of you today. And to me, the second point is that all of you invest in different ways, right, to get income. Very basic, fixed deposit. Then you go to bonds, which FSM have a bond platform whereby you can buy individual bonds. Some of you buy shares and stocks to get dividends. So that's very silo, right? In my opinion, why don't you combine all in one portfolio? So that's the essence of my sharing today. And at the end of the day, my last point would be inflation increase your cost of living. Back to my nasi lemak inflation indicator just now. So our income strategy should be, as inflation grow, your income should grow. Not just this year, the year so on and so forth. So that's, I think, very, very crucial for our asset allocation for 2026. So with that, from question 1, in terms of how we feel about the markets and how multi-asset can do a very meaningful role in our portfolio. Instead of relying one income source, go for more, right? So multi-asset means not relying on just one income source. So, pardon me, this chart is very colorful. No need to see the individual color box, but the intention is to show you, ladies and gentlemen, winners rotate every year. So instead of going for individual winners, I feel that we should go for multiple winners in our portfolio. That's the whole thing about diversification. So you may lose on one market, but you may win on other markets. Of course, at the end of the day, you want the winners to be more than losers of your portfolio. So this is the essence of why multi-asset can help build your portfolio resiliency. So I would like to use the analogy, right? When you go on a long business trip or holiday, are you like me? I tend to carry power bank 1, charger 2, charger 3. Do you all do that? Oh, you only bring one charger. So what happened to your charger if it's not compatible with the country that you are traveling? Normally, I'm a bit careful, right? I carry a few more chargers. The same for portfolio, You don't use one income source. You use multiple. So not one charger, but multiple chargers when you go a long trip. So anyway, ladies and gentlemen, so your next question would be, David, actually, what kind of income that we can really get from the market at the moment? So this is a snapshot of our diversified income strategy, how the level of yield, which is the highest blue line here, have behaved over the last 5 years. From 2020 to 2025, I would say it's been hovering about 6 to 8%. Today is still a good 8%. So you may be wondering, hey, Federal Reserve has cut interest rate from 5.5% in 2024 to today 3.5%. They already cut 2% already, So if you realize your US dollar-based deposit have been trending down because interest rates are lower. But how we as investor can maintain 8%? That's the thing that I'm going to review in my next few slides. How do we achieve 8%, right? And bear in mind, this 8% will not last forever. It fluctuates. So which is why we feel, in consultation with my business partners, AHAM Capital and FSM, I feel that it's a good time to talk about, rather than stretching your asset allocation to the most extreme of equities or bonds, embrace both. With that, you are able to get a meaningful yield that can beat the cost of living in Malaysia. So, allow me to share in terms of what exactly we allocate in order that we get such a level of good income yield. So you can see the beautiful pie chart here are basically diversification into bonds. You can do into US government bonds. We can do corporate investment grade. We can do high yield. And also we can do mortgage-backed securities. So with all that combined, plus equities that pay dividend, and also we can creatively extract yield from our hybrid securities. We call it equity-linked notes. Some of you may have in the past bought some equity-linked shares with your advisors. So we do the same in our portfolio. So with that in combined, we are able to get about 7 to 8% income for investors in the last 2 to 3 years already. So you're probably wondering, with this kind of simulated income sources from diversified income sources, what will be the next key strategy to maintain your dividend profile? The consistency is very important. So, in terms of managing your consistency of your income portfolio, and rather than predicting that which income sources will be good for you, my suggestion is to go for both, right? Equity, bonds, and hybrid securities. That's important, but the second component that is important is your flexibility. So sometimes you may be wondering, in terms of market decision, when's a good time to go into the market? For us, it's important, but your flexibility also is, to my mind, is very crucial as well. Allow me to show you, ladies and gentlemen. This is the snapshot of our simulated income strategy. The green line will be the equity. The blue line will be the fixed income. So you can see in 2020, during the pandemic recession, because of policy support by the central banks around the world, we are pro-equities. So we buy equities on the cheap. In 2022, when US start to increase interest rate, we start to switch into fixed income that pays a higher yield. So with that actually helps when every time there's a market volatility, the flexibility will be your, how do I call it? Your portfolio shock absorbers. Like the way you maintain your car, absorber you have to take care as well. When it comes to portfolio, the absorber will come from this, your flexibility and your diversification. So because of that, if you look at the mini box here, in 2022, it was a very bad year. That year, both bonds and both fixed income and equities dropped at the same time. S&P 500 dropped about 19%. US aggregate dropped about 13%. Our simulated income strategy delivered a net return of minus close to 6% in 2022 when the rest of the markets are in a bloodbath, double-digit decline. How do we do that? I find out from my colleagues that manage this income solution, oh, in 2022, we were paying an income of 6 to 7%. Come to think of it, if it's not of the dividends that we pay out on a monthly basis in 2022, the total return would have been minus 13%, which is more in line with the rest of the markets, you know. So not only you get dividends in 2022, in the environment when NAV or prices are declining, that cushion your portfolio volatility, your downside protection. So that is why I want to illustrate being diversified is important, but being flexible also is equally important. So that brings to question 2, ladies and gentlemen. Today I only have 3 questions, then we can wrap up to do Q&A after this. But my Q2 question is, are we still able to get meaningful income in current environment with rates around the world will be coming down in the future? The answer is yes. So long you stay diversified and being flexible, don't rely on one income source. So don't try to find one hero, but find a team of heroes for your portfolio, right? So just to illustrate, this is based on a real portfolio that we manage for our investors. So I call it simulated income strategy. So you can see the line at the most upper line, that's our fluctuation of yield from year 2000 to 2025. The yield will fluctuate for sure, but I just want to reiterate that today the yield is meaningful, 7 to 8%. But one thing that I personally like very much, I'm sure you will agree, is that the dividend amount. So if you look at dividend amount here, based on our real life portfolio that we manage, you can see, ladies and gentlemen, at year 2000, we were paying 4 cents per unit. Today is about 6 cents per unit. So you can see the dividend is quite consistent, right? Regardless of market fluctuation. That's very important. Back to my earlier concept, right? For 2026, it's not all about how you invest, you know. It's about how can I make my money grow faster than inflation. Yes, you got many avenues to do that, but I'm talking about the most prudent strategy to get a meaningful income. So the income that is consistent will help you plan your lifestyle expenses. Some of you got different purposes. Holiday, your children's education, and the list goes on. That's your lifestyle today. But you got to look for retirement in the future. So it sounds a bit like property, right? You buy property to hedge inflation. So you got to find an investment that can act similarly to property. It's a hedge against inflation. So lifestyle today, retirement tomorrow. So dividend amount can be consistent. At the same time, leveraging on a high interest rate currently, this is the Fed fund rate, money markets. Even they cut, we are still talking about Fed fund rate of about 3.5%. Compare that to Malaysia OPR rate of 2%. It's still a meaningful carry. When it comes to your investment exposure, one will have to be diversified, ladies and gentlemen. So from Franklin Templeton, we have been calling for investors in the last 2 to 3 years. When US interest rate is at 5.5, it's time to go search for yield in other markets, especially US. Now that, you know, ringgit is strong as well. I mean, how often ringgit can strengthen 9 to 10% last year, which is good. But have you asked your advisor, how can I take advantage? Time to buy some US denominated assets. Get 8% income in dollar, in ringgit, in Australian dollar, in Sing dollar. Some of you keep a lot of Sing dollar for your children in Singapore. So I would like to encourage you after this weekend, have a chat with your advisor. How can you make your money work harder in multiple currencies? So we are doing that for our clients. That brings to my last question. I just want to summarize question 2. We've read cuts in the last 2 years. Are we still able to get meaningful income? The answer is absolutely yes. Provided you diversify, being flexible, and then don't rely on one income hero. Like say you buy this particular bond from this company in Australia, right? very good income, 5 to 6%, but you are exposed to one issuer risk. So you got to diversify into multiple tranches, right? Multiple bonds, multiple equities, multiple hybrid securities. That's my suggestion to all of you. So consistency is important rather than chasing the highest yield. It's pointless. Highest yield for 2026. Next year, that particular portfolio drop to lower yield. No point. The key thing is consistency. Stretch it over market cycles. That's how you can become rich slower, in a smoother way, of course, right? Slower but smoother way, in a prudent way. Yeah. All right, let's go to last question. This is quite a common question that Malaysian investors ask. When it comes to income, they tend to ask, what about the capital side of things? Does the income erode capital? Does the fund manager use capital to pay income? Left pocket in, right pocket out. This is the quite biggest question, like elephant in the room, right? I want to address. So our take is that I just use one particular slide to illustrate. We can pay income without using capital. Let me show you how. One, I have illustrated that based on current market environment, we are getting about, we look at bonds, by and large, our bonds portfolio, I'm sure your bonds portfolio are yielding about anything between 5% to 8-9%. Whether you buy high yield, whether you buy investment grade, whether you buy government bonds. That's the range of the yield. Stocks and shares dividend yield, give and take 3 to 4%. US, Europe, and even in this part of the world. Not only that, we can go into creatively some hybrid securities to extract higher yield. So with that in mind, plus diversified asset allocation, consistency, we feel that the income portfolio can generate a very meaningful income across market cycle. So I want to prove that. So what you can see in the chart is that a snapshot of a real portfolio that we manage for our global investors. And very interesting. I've been with Franklin Templeton for 10 years. But this one we have been managing for 77 years. Older than most of you here in the room, right? So you can see we started in 1948, August 1948. So if one will have to put in about $10,000 in 1948, with a total return that we generated for our clients in this real life portfolio of about 9.9% per annum. 9.9% per annum for 77 years is a lot of money. So to illustrate that, 10K in 1948, in September 2025, grows to 14.2 million in dollars. So back to my earlier point, right? It's not about chasing the highest yield, chasing the highest investment that can generate double-digit return. The key thing is consistency, ladies and gentlemen. Not chasing the market. Market can come and go, in 2026, similarly in the past. But the key thing, how do we generate consistent 9%, like what we're doing here, 9.9% per annum for 77 years. So this illustration is about how we can grow our money, beating the cost of living in Malaysia. So with that, I think before I wrap up, I just want to summarize. One, I think from Franklin Templeton perspective, we like the market in 2026. We are the view that with the factors from corporate earnings to very supportive central banks in the name of US Federal Reserve, we should see some positive effects from interest rate cut, a lag effect actually, because they've been cutting 2 years. So we should see a lag positive effect drill down to economy in the US for this year. So that should bode well for global market in 2026. I have one contention only. The margin of safety in equity market currently, if you look at the world market are at, US is record high, Europe markets are at 4-year high, China, Hong Kong market at almost 5-year high, Japan market is 30-year high. Where do we allocate our money in this environment? Go for multi-asset. At the same time, while we're waiting for your portfolio to grow in other areas, my only contention is that the margin of safety is not enough. That means if earning means from some of those AI companies, some not so discouraging news from geopolitics, that could be risky for markets, ladies and gentlemen. So my urge to you is stay diversified, be flexible, talk to your advisor more often on how we can help you to generate a meaningful income. That's the message that I want to deliver today. With that, I wish all of you the best in this new year of 2026. May you have a profitable year with FSM Expo. Thank you very much.